A higher for longer rate and scenario also voiced by US Fed Chair Jerome Powell really pressures the stocks today. Financials and energy lead the decline, while FMCG and autos eke out gains.
The Supreme Court extends the stay on the long-awaited open offer to Fortis Healthcare shareholders by IHH. The move dashes hopes and dents the stock.
Dodla Dairy gains after notable investors check in, while SpiceJet sulks after DGCA extends a cap on its flights, even as sources suggest it may hike staff salaries.
The rupee breaks the 80 per dollar barrier as RBI lets go. All Asian currencies are down 0.5 to 1 percentage point as the Fed shocks with the guidance of 150 basis points more of rate hikes.
Hello and welcome. You've tuned into Business Lunch. I'm Nisha Podar, and with me, as always, is my co-anchor Pavitra Parekh. So, Pavitra, let's begin with the markets. And yes, overnight we all were glued to our televisions and our Twitter, feeds because of the US Fed's really pronouncement on the interest rates. And yes, what was expected has been pronounced, 0.75 basis points hike, and that has also had a cascading impact on global markets, US, and therefore India as well. At the moment, 0.8% down on Nifty 50. 17,500 level has been, though, defended by the markets, and one must look at that particular level as well. As far as Bank Nifty is concerned, that is the one which is really taking the huge amount of brunt for the kind of global scenario that we are seeing, and also global market pressure. And therefore, it's 1.7% down in trade at the moment, while mid caps are the ones showing some bit of resilience, outperforming the key indices, but still close to 0.5% down. And no surprises then, advanced decline ratio in favor of the declines today. But since there is a mid-cap outperformance, it's not as bad as it could have been because of the pressure, especially coming in from the financials. But Hindustan Unilever, Eicher Motors, ITC, as well as Adani Ports are some of the counters which are really gaining in trade and having a contra movement to the overall market weakness. Pavitra.
Hi, Nisha. Good afternoon. So, like you were pointing out, we definitely got that 75 basis points hike. But more than that, it was the commentary that they're looking at 150 basis points more that really sort of rattled markets. And that's what's going down. Our markets are down, definitely not out. If you take a look at what's happening in the broader context of Asia, Hang Seng is down 2% right now. You're seeing the cuts come through in the Japanese markets in Taiwan as well. So our market's holding up in that space. But I do have to point out that the S&P 500 futures are also down around 1%. So do keep that on your radar. What's holding up? The FMCG stocks, some of the auto names as well. And I would watch out for the entire tech pack because the Accenture Q4 earnings are today. And more importantly, the guidance for the rest of the year is going to be out. So keep your eye out on the entire tech pack. It is really, all of the financials on the downside and Reliance, which are adding some pressure. So that's what's happening with the market action. We're going to keep coming back to this. But first up, the big global cue that we've been talking about. As the US Fed has hiked rates by 75 basis points for the third straight time, Prashant has walked over to the big wall and he's standing by with the 10 key takeaways from the event. Prashant.
Well, thanks very much for that. So the big event is out of the way with largely hawkish implications. Let's get to it then, right? And I'll break this down in 10 points. So number one, the Fed has delivered a third consecutive 75 basis point rate hike, which is in line with market expectations and consistent with recent Fed communication as well. Number two, while there were no major changes to the statement, the summary of economic projections showed a sharp increase higher in the federal Fed funds rate. These are projections of what the Fed sees its own Fed funds rate will be by the end of the year, by the end of next year, and so on and so forth. Number three, the median for 2022 in terms of these rate projections was taken for the end of this year from 3.375, that is 3.4, to 4.4% nearly. What this implies is important. Consider this. This implies that the median participant in the FOMC committee is looking for another 125 basis points of hikes in the remaining two meetings of this year, that is November and December. That is significantly higher. Number four, the 2023 dot, which is next year, went from, these are, again, I'm saying projections for where the Fed sees its own Fed funds rate at. It went from 3.75% so far to new estimate of 4.625%. This implies another 2 hikes next year beyond what they expect the Fed to deliver by the end of this year. On top of that, the 2024 and 2025 rate projections show modest gradual normalization. They expect rates to come down to about 3.875 and 2.875 as well. But even these rates are in the restrictive zone. We're talking about 24-25. Number 5, Fed Chair Powell's first answer to the question in the press conference was prefaced by him with this comment. But even before he took the question and began answering, he said, "The main message for me has not changed at all since Jackson Hole," end of quote. So he wanted to make sure that there is absolutely no confusion what the focus for the Fed is, which is fighting inflation and bringing it down to 2%. Number 6, these are economic forecasts now. Just like there are rate projections, there are economic projections as well. They were also revised, but mostly in a more pessimistic fashion. Why? Number 7, unemployment rate projection for 2023 and 2024 is now expected at 4.4%. This is an upward revision of about 0.5% and 0.3% respectively. The other projection is the growth projection for 2023, which was revised down, while inflation projection was revised higher. So it's the opposite of what you would want to see. Growth is being revised lower, inflation is being projected higher, and rate forecasts are moving up as well. Number 9, Powell in his prepared remarks, this is the statement which he reads off before he takes questions, highlighted that the restrictive stance of the policy is likely for some time and that history cautions strongly against prematurely loosening policy. This was the one big notable change from his July policy statement. Otherwise, there wasn't very, and this change is relatively at the margin hawkish. And last point, number 10, in the press conference in response to a question as to what will cause the Fed to slow or pause these rate hikes, right? Powell outlined 3 conditions: below trend growth, softening in labor market, and a clear evidence that inflation is moving to 2%. I mean, to summarize, I would say that this Fed meeting outcome has managed to surprise even the raised bar of hawkishness. The street and the market will have to play catch up with the Fed. Back to you.
All right, Prashant, thanks so much for breaking it down for us and giving us the full insight of what US Fed Chair really had to say. Let's hear out the man himself, and his commentaries are extremely important for the movement of global markets for some time to come. Hear him out.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025.
All right, that is U.S. Fed Chair Jerome Powell once again reiterating that they will do what it takes to restore price stability and get back to their 2% inflation target. But we've also been talking to a whole host of market watchers this morning, so let's listen into what Eddie Ardini of Ardini Research as well as Goldman Sachs' Sunil Kaul had to say.
The Fed does not have a great track record of being accurate on forecasting the economy, especially since the pandemic. I think very few people have really been able to assess where the economy is going now since the pandemic. So it's a very difficult environment to try to forecast. And I think the Federal Reserve has just come to realize since the beginning of the year that they completely got inflation wrong and that they have to catch up. It turned out to be more hawkish than the markets were anticipating. And I think the markets scrambled in the afternoon to kind of catch up with what they were reading in that summary of economic projections.
The 75 basis points hike which we saw was in line with our expectation. The guidance obviously was a little bit much more hawkish, both in terms of the dot plots, but also in terms of the press conference later. And so we were actually looking at the Fed terminal rate of 4 to 4.25 range, and obviously the target rate was 50 basis points higher. So as a consequence of that, we also just changed our rate forecast. So we are now looking at a similar target Fed fund rate at 4.5475.
All right, so all that analysis and comments really coming in on U.S. Federal Reserve's announcements. Not just the equity markets, in fact, the money market in India is also weak today after a record low open of 80 rupees 28 paise per dollar. The rupee has extended its losses and is currently around 80 rupees 70 paise against the dollar. Lata Venkatesh is right here to tell us where the rupee could be headed and also the impact of it on the bond market. Lata.
Well, it's quite a historic day. For so long, the RBI had protected the 80 rupee to the dollar mark up until yesterday, as it were. And more hawkish than expected Fed has allowed the RBI to let the rupee breach that mark. In fact, it's done more. Today is perhaps, in intraday terms, at least one of the sharpest falls for the rupee in a day. All Asian currencies have fallen between 0.5% and 1%, and the rupee is at the higher end. It's fallen intraday by 1% thanks to this guidance. And it had to. I mean, this was a writing on the wall. Also, because of the China factor, the rupee has appreciated versus the Chinese currency considerably. From March, it required 12 rupees to buy a yuan. In July, you required 11 rupees 80 paise to buy a yuan. And as of yesterday, you required only 11 rupees 30 paise to buy a yuan. That's not good because we have the highest trade deficit with China. So the dollar is one reason, but the yuan is another big reason why the rupee had to be allowed to be depreciated at some point in time. And the question now in the market is, what will be the new pivot or low for the rupee? Will it get protected at 80.25? And how much will the RBI, support at the higher end? Will it be 81? Will it be 82? There are all kinds of debates, and the days to come will tell you that. The bond markets have also seen a significant fall for several reasons. US yields have gone to 3.5456. The Indian bonds didn't adjust. A weaker rupee also means expensive imports, and that also has a bond negative, higher inflation impact. So today there was this 10 basis point adjustment. The market is also veering around to the view that India's inclusion in the JPM bond index is not imminent at all. Which means, what is the reason to buy bonds right away? There are more inflationary reasons. The market is also adjusting to the fact that come September 30, a 50 basis hike from the RBI is more likely than 35. And that explains this 10 basis point rise in spot bond yields and a 20 basis point rise in the OIS market.
All right, Lata, thanks a lot for getting us all of that action that we're seeing play out in the rupee as well as in the bond markets. But with that, it's time for our first short break in the show. When we come back, like we told you, the Supreme Court has ordered continuation of stay on IHH's open offer for Fortis hospitals. We'll get you all of the details after this short break. Welcome back. You're still tuned into Business Lunch on CNBC-TV18, and an important stock-specific story today. The Fortis stock is currently down around 17%. This after the Supreme Court extends the stay on the long-awaited open offer to Fortis Healthcare shareholders by IHH. It has also directed the Delhi High Court to consider appointing a forensic auditor for the IHH deal. So Ekta is here with all of the details. Ekta.
Thanks for that. Well, yes, definitely a setback which is coming for Fortis as well as the shareholders as well as the promoter IHH. Now, basically, what does this mean for IHH? A delay in the open offer as well as the possibility of a forensic audit. Now, the Fortis management in the past has said that IHH is in fact committed to Fortis. Analysts, however, point out concerns on the IHH commitment when it comes to, going full gung-ho on growth because of the uncertainty of a possible forensic audit as well as the uncertainty of an open offer. The Fortis stock in that case could possibly be an M&A candidate according to analysts. Now, what does this mean for shareholders? The delay in the open offer has now been since close to 4 years. SEBI too, for example, had urged the courts in 2020 to in fact allow the open offer to go through. Experts say, however, that the open offer has to be put into context, and in this case now the validity of the deal is in question, hence the open offer does not take precedence. I just want to add that since the past 4 years, shareholders, however, have had the option of exiting the Fortis stock even at a higher price than what the open offer price was at that time, which was 170 rupees per share. Now, what about the Fortis stock as well as the overall performance in the past 4 years? The stock, in fact, has been an outperformer. It's given returns of around 90% if you compare it for the open offer price of 170 to the 52-week high, which it was sitting at over 300 rupees last week. And Q1 FY23, the numbers were strong. The elective surgical revenue, which is 61% of the revenue, was at an all-time high. Q1 FY23 margins were at 17%, which improved. Hospital occupancy was at 65%, expected to improve to around 70%. International patient revenue also was up around 126% year on year. So it's really firing when it comes to the hospital business. The management has said, Fortis has put out a statement that they will be looking at seeking legal advice with regards to what has taken place today. But on a larger context, the street will be watching out details when it comes to a possible forensic audit, open offer movement, as well as what the IHH commitment and plans would be going forward.
All right, an important and precedent-making decision this one is coming, and as far as M&A and deal scenario is concerned, where open offer was not allowed, there's a stay that continues on the open offer while the deal has already been done. A quick look at the markets, and yes, there is some bit of buying seen at the lower levels, and especially in the banking space. So take a look at Bank Nifty at the moment, 1.35% down in trade, and there is some buying seen in some of the big banks like Kotak Mahindra Bank, SBI, ICICI, Axis Bank, and mid-cap universe. Keep an eye out on that. That is also inching towards a flat line. Nifty and Sensex about 0.5% down. So some bit of buying and some bit of relief that is coming in the market. Shifting focus to some important news flow coming in from the telecom sector now. And the Department of Telecom has released the draft Telecom Bill for public comments. My colleague Abhimanyu is here to tell us more about that. It's important to remember because OTT, which is the new age game, may come under the fold of regulatory framework. Abhimanyu.
DoT has introduced a draft telecom bill to provide relief to stressed carriers. The bill seeks to simplify the framework for mergers, demergers and acquisitions or other forms of restructuring by only requiring intimation to the licensing authority. The Telecom Department has put out the draft Indian Telecommunications Bill 2022 up for stakeholder comments by the 20th of October, under which the framework for mergers and acquisitions will be simplified and the relief, write-off or deferment of dues may be allowed in cases of payment default in extraordinary circumstances. Companies will have to comply with the restructuring scheme under the Companies Act and inform the Department of Telecom accordingly. In case of default payment of any amount, the government will determine the extraordinary circumstances, which will include financial stress, consumer interest, maintenance of competition in the sector, or reliability and continued supply of services to allow full or partial relief, write-off or deferment or conversion of amount into shares through a special enabling framework. Spectrum allocated to telecom companies presently undergoing insolvency that are unable to offer services, pay dues or comply with license conditions will be taken back by the government.
All right, Abhimanyu, thanks a lot for getting us the latest on the draft telecom bill. We have to get into a short break now, but you don't go anywhere because we have some excerpts from our exclusive conversation with JP Morgan's Jamie Dimon coming up for you after this short break.
Welcome back to Business Lunch, and here's an exclusive chat with JP Morgan Chase Chairman and CEO Jamie Dimon, who spoke to Shireen Bhan on global economic outlook and the look ahead for India and global equity markets. Listen in.
There's a lot of turbulence out there, and I was never trying to predict a hurricane. I was simply trying to explain to people that it could be a very modest storm, like it could dissipate quickly, or it could be a hurricane, and that people should be prepared for getting worse because we've never, this war, quantitative tightening, fiscal stimulation, the tension between America and China, these are just very serious things that have, bad economic outcomes.
Well, speaking of bad economic outcomes, are you now penciling in the worst case scenario, given the fact that central bankers have no choice but to continue to tighten? And what we have seen at this point in time is further deterioration as far as Russia and Ukraine is concerned, and further tension between China and the US over Taiwan. Are you now bracing yourself for the worst outcome?
No, I mean, maybe you'll be surprised, but when I said it in June, I expected all those things to happen. More inflation, higher rates. I talked about an unpredictable war. Wars are unpredictable. I still think the range of outcomes is a range, and you should look at it. I think a soft landing is probably a very small chance at this point, but mild recession, hard recession, they're all possible. And it's hard for me to give them odds, but they're all kind of possible. And remember, when I say get ready for it, I'm also talking to companies and investors where my real point is we're prepared for it so we can serve our clients. We're going to be serving clients in India regardless of whether it's a hurricane or a mild storm. And that's why I think people should be prepared. I'm much more concerned, by the way, about the humanitarian crisis, the war. These are bad things. Volatile markets we can all deal with. But there are a lot of people who are being hurt by these conditions around the world.
All right, that is an interesting conversation with Jamie Dimon. We're going to wind down on the show. It's currently around an 85-point cut that we are seeing on the Nifty. So there is a recovery and that we are seeing play out in the markets. But we're completely out of time. So thanks a lot for tuning into Business Lunch. We have Mid Cap Radar up next.